Good morning. Let's make a brief analysis on APLX. Ticker symbol is APLX. This is the chart since the IPO back in 1994, and the stock has been very volatile. As you can see, it has these big rises and falls, but the current ascending trend seems more sustainable, going from a low here in 2001 and slowly going up. Over the medium term, we have this. I don't know what happened here in point 1 because my news database doesn't go this back, unfortunately, but I would like to know. Probably this was an earnings miss or something like that. Here on point 2, it was a positive earnings surprise, and the stock has been rising ever since. It's well, let's move on to the short-term chart. It's interesting to see that this candle was bearish and the stock even went down from this level, but now it is way above it. So when something like this happens again, don't be scared, because it doesn't mean much. This is a correction from this big gap up here. Over the short term, volume has been picking up steam. You can see that it has been way above average and the stock has been rising. There's no doubt the trend is bullish, with the 50 days above the 200 days and the price above the two moving averages. Let's check my valuation model. Okay, here we have the initial share price, which is the current market price, 16.5, and as for the share count, I have 15.91 million shares outstanding. This is basic, because on a fully diluted basis there are more than 17 million shares, and I put here a dilution factor of 5%. This has been the historical average. This company has this bad habit of just a second, let me try to put the window at the recording window here. Okay, now let me show you here 10-year summary. And you see here in 97 they had 10.1 million shares outstanding and 15.91 million now, so it has been rising steadily, even though the balance sheet looks healthy here with 66 million in current assets and 29 million in current liabilities and just 3.79 million in long-term debt. So they don't need the cash, but they keep diluting shareholders' value. And you can see here also that sales have been quite erratic. They were 48.5 million in 97, and at this 2006 52 million. It was a record high, but just a bit above the 10-year ago level. That also explains why the stock has been up and down so much. But wait, earnings per share have been rising. Look here, 1 cent in 2003, 31 cents in 04, 42 cents in 2005, and 56 cents in 2006. For 07, analysts are expecting just 51 cents, which doesn't seem reasonable at all, because in the first quarter the company already made, let me just check that again, where is it, they already made 4 cents per share, but this is a seasonally weak quarter, but I believe there will be growth, so earnings per share will probably be more than 51 cents in 07. Okay, where were we? Okay. With this dilution factor, it gives me a final share count of 18.4 million shares, and the initial revenue is the revenue the company had over the last 4 quarters. It was $56 million, and I expect revenues to grow 35% a year going forward. They grew 44% a year from the year ago in 2006, from 2005, and in the first quarter they grew more than 50%, so I believe 35% is conservative. It can be more, but I like to keep this a bit conservative here with 35% revenue CAGR going forward, and this gives me final revenue of 138 million. This is for 2009. Initial net profit margin, this is what we had in in 2006, 17.3%. I expect this to expand a bit to 20%. This is a fat net profit margin business, a software business, and this gives me final net income. This is for 2009 of 27.6 million, or $1.50 per share. If we apply the, let me see the industry, which one is it? Here at competitors. This is the application software industry, which trades at an average PE of 31.98, and that's what I have here in my valuation model. And computing all this, I see this stock at $47.83 in 2009, which means a share price CAGR of 42.6% and an optimal selling price of $30.65. This would be today. So with the stock at 16 and 49, I believe it is very attractive. On a 1 to 10 scale, I give it an 8. Thanks. Bye.